All right, today we are taking a really close look at Qualcomm. Think of it like a complete financial checkup. We're going to break down all the key numbers to figure out what really makes this tech giant tick, especially from an investor's point of view.
So, Qualcomm's caught your eye, huh? That's great. Let's dive in together, pull back the curtain on the numbers, and really see what kind of story they're telling us about the company's financial health.
Okay, first things first, what's the price tag on this thing? Is the stock a bargain right now, or is it kind of pricey? Before we go any deeper, we've got to understand what the market thinks Qualcomm is worth today.
Now, the most common way to check that price is with something called the PE ratio. It's actually a pretty simple idea. A higher PE number generally means the stock is more expensive compared to what it earns. A lower number? Well, that suggests it's cheaper. It's like a quick snapshot of how everyone's feeling about the stock.
And right now, Qualcomm's PE ratio is sitting at 30.75. So what does that mean? It means investors are willing to pay almost $31 for every single dollar the company makes in profit. Now, just hold that number in your head for a minute, because we're about to look at something very, very different.
See, company earnings can get a little complicated sometimes. That's why a lot of really sharp investors like to look at the price to free cash flow ratio instead. Because, cash is king. It's the real money a company has to pay dividends, buy back its own stock, or pour back into the business. This ratio tells us what we're paying for a dollar of actual cash that's flowing through the company.
And would you look at that? It's just 12.43. Remember that PE ratio of nearly 31? This price to free cash flow number is less than half of that. That huge difference right there hints that this is a company that is just incredibly good at generating cold, hard cash.
So here's where context becomes everything. When you compare it to its own 3-year average, that PE ratio is running pretty hot. It's over 36% higher than usual. But then you look at the PF-CF ratio, and it's actually more than 11% cheaper than its recent average. This is what we call a mixed picture, and it suggests the stock might be expensive by one yardstick, but maybe even undervalued by another, more cash-focused one.
So the price is one part of the story, right? But what about the perks of just owning it? What do you get for holding the stock over the long haul? For a lot of investors, the answer to that is all about the dividends.
Get this. For 23 years in a row, Qualcomm has increased the amount of cash it pays out to its shareholders. Just think about that for a second. Through all the market's ups and downs for over 2 decades, that dividend payment has only gone up. That's a really powerful signal of financial strength and stability.
And if we dig a little deeper, we can see just how fast it's been growing. Over the last 5 years, the dividend grew at an average rate of almost 6.5% per year. Now, yeah, that growth has slowed down a little bit in the last year, but it's still a really healthy, steady climb.
But the big question is, can they keep it up? That's where the payout ratio comes in handy. It basically tells us how much of the company's money is being used to fund that dividend. If that number gets way too high, it could be a red flag that the dividend might be at risk. And here's where that whole cash flow story we talked about becomes so important. If you look at the free cash flow payout ratio, which is honestly the more telling number, the company is using less than 30% of its actual cash to pay its dividend. That leaves a huge cushion. It tells us that the dividend isn't just safe, it's extremely well covered with tons of room to keep on growing.
Okay, so we've got a mixed valuation and a really strong dividend story. Now let's pop the hood and connect all of that to the engine of the business, its actual performance. How is the company itself really doing?
And here we are at the central puzzle of Qualcomm. Just look at the two sides of this. Sales have been growing like crazy, averaging over 12% a year for 5 years. That's impressive. But at the same time, the profits, they've actually been shrinking. So while the company is definitely getting bigger, it's also become less profitable lately. That's a key tension we have to keep in mind.
And you can see that internal struggle reflected pretty clearly in the stock's performance. As you can tell, owning Qualcomm has been a bit of a roller coaster. A massive drop in 2022 was followed by a huge rebound in 2023. And while we all know past performance is no guarantee of what's next, this history is a really important reminder of how volatile even a massive company's stock can be.
So we've looked at the price tag, we've checked out the perks, and we've peeked under the hood at performance. Now let's put all these pieces together and see what kind of picture emerges for a potential investment.
One of the most important ideas in value investing is called the margin of safety. It's a simple but powerful concept. It's like buying something for 50 cents that you honestly believe is worth $1. That gap, that buffer, is what protects you from being wrong or just from a bit of bad luck.
So let's start with what we know for sure. As of the last market close, a single share of Qualcomm cost you just under $149.
Now this is where things get really interesting. Based on a standard financial model called a discounted cash flow analysis, which basically tries to figure out what all the future cash is worth today, the calculated fair value for the stock is over $421. That is a huge number, and it all comes back to that powerful cash-generating machine we keep talking about.
So the difference between the market price and that calculated value, it's pretty staggering. It implies a potential margin of safety of almost 65%. Now, of course, this is just one valuation model, but according to this one, the stock isn't just a little cheap, it could be deeply undervalued. So let's just do a quick recap of our checkup. The valuation? It's a bit tricky, right? Some numbers say expensive, others say cheap. The dividend? That's a rock-solid story of rewarding shareholders year after year. Performance shows a company that's great at growing sales, but has been struggling to turn that into profit lately. And finally, those cash flow models suggest there might be a massive margin of safety at today's price.
And that really brings us to the final question, the one that truly matters for you. When you weigh everything, does that massive potential margin of safety get you excited? Or are you more concerned about the recent struggles with profitability? Your answer to that question is really the key to your own investment decision.